founders got another term that like EBITDA, that old earnings before interest, taxes, depreciation, amortization, that comes up from like the archives of your accounting memory. Another one that comes up a lot in deals, will catch you probably by surprise and might even lead to more problems after the closing than some of the larger number kind of factors in your deal, is net working capital or working capital. There is usually, sometimes in a letter of intent, always in a purchase agreement, some reference to a net working capital peg or formula. What that means is that because net working capital in a nutshell and deal math, this is not accounting math, this is deal math, is essentially set aside cash for a second and debts for a second and just say accounts receivable plus inventory minus accounts payable, including taxes payable in like a pass-through entity like an LLC or an S Corp. So generally speaking, a net working capital peg, your deal is probably going to be done on what's called a cash-free, debt-free basis, which means the cash on your balance sheet when you sell is yours as long as the debts are paid off, right? So if you have no debts, no bank line of credit, no longer term debt, cash is all yours except for the net working capital. What this is meant to do is make sure that when the transaction closes, there's enough cash in the business to keep running the business, and that the buyer, whether they're a private equity firm or a strategic buyer, doesn't have to move money from their balance sheet or their fund into the company to make payroll or pay the payables or anything like that. So the attempt here is so that the purchase price doesn't need to be adjusted at all by either side. Nobody actually wants there to be a dispute about working capital, but it ends up being a pretty big deal in the sense that you can't really predict exactly what it's going to be. Now, your net working capital peg or formula is usually going to be your financial accounting or CFO trying to figure out for you on whether it's a monthly, quarterly, annual basis, what the average net working capital of the business is. If you deliver the business with less than that, then you're going to owe part of the purchase proceeds that you're getting back to the buyer. And if you deliver it with less than that, then they're going to owe you some more money. So think of it as delivering a used car with a full tank of gas and topped off oil. So you're delivering it in good working condition and that it can keep operating the way it's supposed to operate. We bring this up, even though it seems arcane, you pretty much in our world never see anybody get sued or there being a big dispute about, say, a non-disclosure agreement, which is a legal agreement that goes back and forth between the two sides. But a net working capital peg or a net working capital formula, lots and lots of post-purchase disputes about that. So be careful about this one and don't agree to it in a letter of intent until you understand exactly what it means. Remember, that letter of intent is a ceiling. It only gets worse after that. So don't agree to anything under the assumption that it's all going to get worked out afterwards because you're going to be partners and you're going to be skipping down the path together. Get that nailed down up front and make sure you understand what that means and what that formula could mean to you or for you.